It's Tuesday morning. You walk into your bank to withdraw your own money. The teller looks at you. She doesn't blink. She doesn't speak. She just slides a small printed notice under the glass. Withdrawals suspended. You feel the heat rise in your neck. You bang on the glass. You point to your balance on the app. It says the numbers are there, but the liquidity is gone. Now imagine this isn't 2026, it's 1931. And the reason you can feed your family isn't because the money disappeared, it's because your government decided that a shiny yellow metal in a vault was more important than your survival. We are told that gold is the ultimate safety, the hedge against chaos, God's money. But history tells a darker story. A story where gold wasn't the savior, it was the cage. The Great Depression wasn't an accident, it was a machine. A machine built by golden fetters. And right now, the global economy is being handcuffed again, just not by gold. To survive what's coming, you need to understand how the ultimate asset became the ultimate weapon. Welcome to the history of the future. Let's strip away the mythology. Most people think the Great Depression started because the stock market crashed in 1929. They are wrong. A stock crash destroys paper wealth. It doesn't destroy civilization. Stocks crashed in 1987, in 2000, in 2020. We didn't see mass starvation, so why did the 1930s turn into a decade of hell? The answer lies in a rigid mathematical equation called the gold standard. Here is the mechanism. It sounds simple. Sound money. Honest money. For every paper dollar in circulation, the central bank holds a specific amount of gold. If you have $20.67, you can walk into a bank and demand 1 ounce of gold. It's a promise, a contract, and in fair weather, it works perfectly. It keeps governments from printing too much. But what happens when the weather turns? When the economy slows down, fear spikes. People stop trusting banks. They want the metal. They rush to the window to trade their paper for gold. Now, the central bank has a problem. Gold is draining out of the vault. To stop the bleeding, they have to make the paper money more attractive. So they raise interest rates. They make it expensive to borrow. They tighten the screws. Think about that logic. The economy is crashing. Businesses are failing. People are losing jobs. And the central bank decides to raise rates and cut off credit. Why? To save the economy? No, to save the gold peg. They chose the system over the people. This is what historians call the golden fetters. Handcuffs made of gold. It's a concept known as the impossible Trinity. You cannot have free capital flow, a fixed exchange rate, and an independent monetary policy all at once. The nations of the 1930s sacrificed their independence to worship at the altar of fixed exchange rates. And the result wasn't stability. It was a mathematical suicide pact. While the world burned, the bankers were busy polishing the bars in the basement. They protected the asset and liquidated the society. Does that sound familiar to you? You might be thinking, but gold is real money. How could real money cause poverty? Let's look at the crime scene. 1931. The global financial system is beginning to crack. Great Britain is the center of the financial universe. The pound sterling is as good as gold, literally. But investors are panicked. They start pulling gold out of London. The Bank of England has a choice: raise rates to 10%, crush the British homeowner, destroy British industry, but keep the gold, or break the promise. On September 19, 1931, they did the unthinkable. They severed the link. Britain left the gold standard. The experts screamed. They predicted hyperinflation. They said the pound would become worthless. But here is what the history books often gloss over. Britain's economy recovered, almost immediately. By cutting the fetters, they could lower interest rates. Money started moving again. Factories reopened. Now compare that to the United States. In Washington, President Hoover was a true believer. He believed that leaving gold was a moral failure. So, as 9,000 banks failed, as millions lost their life savings, the Federal Reserve tightened the supply of money. They were afraid that if they printed money to help the banks, gold would flee to Europe. It was a self-inflicted wound. While Britain was recovering in 1932, America was descending into its darkest year. Unemployment hit 25%. People were boiling leather shoes to make soup in Hoovervilles. Why? Because there wasn't enough gold to back the money needed to run the economy. It's a simple supply and demand issue. If the amount of gold stays flat, but the number of people and goods grows, then the price of goods must fall. That is deflation. And deflation is the most destructive force in finance. When prices fall, you don't spend, you wait. Why buy a car today if it's cheaper tomorrow? Spending stops, income stops, debts remain fixed. Imagine owing $100,000 on a house, but your wages get cut in half every year. That was the reality of the gold standard in the 1930s. The countries that stayed on gold the longest, the US and France, suffered the most. The countries that left early, Britain, Japan, Scandinavia, recovered the fastest. The data is irrefutable. The safety was the danger. But the story doesn't end with economics. When you starve a population to protect a mathematical ratio, you don't just get poverty. You get monsters. In Germany, the adherence to hard money policies in the early 30s created the vacuum that allowed a dictator to walk in and promise salvation. The road to hell wasn't paved with paper money. It was paved with gold. This brings us to the ripple effect. Because systems are interconnected, you break one link and the chain whips back to hit you in the face. When the gold standard forced nations to protect their reserves, they turned inward. If you can't devalue your currency to sell more goods, you raise tariffs, you build walls. The US passed the Smoot-Hawley Tariff Act. It was meant to protect American farmers. Instead, it strangled global trade. Ships stopped docking. Wheat rotted in the silos, because nobody had the gold to settle the trades. Understand this. The world had the resources. We had the factories. We had the men. We had the food. But we lacked the tokens to facilitate the exchange. It's like dying of thirst next to a vending machine full of water, because you don't have a quarter, and you refuse to use anything else. This rigidity broke the social contract. Men who had worked their whole lives, who believed in the system, found themselves standing in breadlines. Their savings were in banks that had closed. Their skills were useless in a frozen market. And here is the psychological pivot. When the system fails to provide utility, people stop caring about its morality. They didn't care about sound money anymore. They wanted action. In 1933, Franklin D. Roosevelt did what Hoover wouldn't. He confiscated the gold. Executive Order 6102. He outlawed the ownership of monetary gold. He broke the fetters by force. He devalued the dollar. And the economy began to breathe again. It wasn't fair. It was theft, technically. But it proved a brutal truth about finance. Money is a tool for the living, not a monument to the dead. If the tool stops working, you don't die with it. You break it. The gold standard didn't die because of a conspiracy. It died because it was too rigid to survive a complex world. So, why does this history lesson matter to your bank account today? Because we are walking into the same trap. But the fetters have changed. Today, we aren't handcuffed by gold. We are handcuffed by debt. The system requires constant inflation to service the debt. That is the new rigidity. The central banks cannot let deflation happen. They can't let prices fall. If they do, the $300 trillion debt bubble implodes. So they are forced, mathematically, to debase your currency. In the 1930s, the fetter forced them to tighten until you starved. In the 2020s, the fetter forces them to print until you are erased. It's the same outcome, from the opposite direction. So, what is your move? First, realize that systemic safety is an illusion. The bank is not a vault, it's a hedge fund. Second, understand the value of liquidity versus solidity. Gold is great, it's a store of value. But in 1933, it was confiscated. It was hard to move. You need assets that are liquid, portable, and outside the system's direct control. This is why people look to digital bearer assets. Not because they are tech bros, but because they are unfettered. However, the ultimate lesson of the Great Depression is counterparty risk. If your wealth relies on a government keeping a promise or a bank staying open, you don't own it. You are renting it. The people who survived the 1930s weren't the ones who trusted the gold standard. They were the ones who held productive land, useful skills, and assets they could physically control. History punishes the rigid. It rewards the adaptable. Don't be the person waiting for the bank to open. Be the person who doesn't need it to. The gold standard was a beautiful idea. It was disciplined, it was honest, and it failed. Because in the war between math and survival, survival always wins. We are approaching another reset. A new Bretton Woods. They will tell you the new system is for your safety. They will offer you a new digital cage. Will you walk into it? Or will you build your own exit? I want to hear your argument in the comments. Do you think a return to the gold standard would save us? Or would it just cause another depression? Is Bitcoin the new gold, or just another fetter in disguise? Debate it below. I'll be watching. And remember, if you're ready to stop guessing and start understanding, subscribe now. The past is a blueprint. Let's read it together.